Have you ever noticed how price sometimes explodes through the market without slowing down? Then months later, it suddenly comes back to the exact same area. Most traders think that's just another pullback. It isn't. What you're looking at is often the footprint of an imbalance that the market never fully dealt with. This is called a liquidity void. In this video, you'll learn what a liquidity void really is, why it forms, what it tells you about market behavior, and how to use it as context instead of blindly trading it. What is a liquidity void? Let's start with the basic idea. A liquidity void is an area where price moves so quickly that very little trading takes place. In other words, the market moves with such strong momentum that it doesn't spend enough time exchanging orders within that price range. Think of it this way. Normally, price moves by continuously matching buyers and sellers. But when one side completely overwhelms the other, price accelerates. Instead of moving in a balanced way, it races through a price range, leaving behind an area with relatively little trading activity. That area is known as a liquidity void. The important thing to understand is that a liquidity void is not a signal by itself. It doesn't tell you to buy, it doesn't tell you to sell. Instead, it gives you valuable information about how the market moved. It tells you that buyers or sellers were so aggressive that price had no reason to slow down. And whenever you see that kind of aggressive movement, you should ask yourself one simple question. Why was the market in such a hurry? Why does a liquidity void form? A liquidity void doesn't appear by accident. It forms because the market becomes temporarily unbalanced. At any moment, the market is constantly matching buy orders with sell orders. When that balance exists, price moves in a relatively controlled way. But sometimes, one side becomes much stronger than the other. Buyers become so aggressive that sellers can't absorb all the buying pressure. Or sellers become so aggressive that buyers can't slow the move down. As a result, price accelerates. Instead of spending time trading at each price level, it rushes through the area with very little resistance. That's exactly how a liquidity void is created. This tells you something important. The move wasn't weak. It wasn't random. It was driven by a strong imbalance between buyers and sellers. And that's why liquidity voids deserve your attention. They reveal where the market showed exceptional strength and moved with urgency. What does a liquidity void tell you? This is where many traders get confused. They see a liquidity void and immediately think it's a trading signal, but that's not what it is. A liquidity void is information. It tells you that the market moved with exceptional conviction. It tells you that one side completely dominated the other. More importantly, it tells you that price was willing to leave that area behind without spending much time there. That doesn't mean price will never return. In fact, markets often revisit these areas later. But when they do, don't assume the market must reverse or continue. Liquidity void versus fair value gap. Now, let's clear up one of the biggest misconceptions. Many traders use the terms liquidity void and fair value gap as if they mean the same thing. They don't. A fair value gap is a specific price imbalance that forms between three candles. It has a clear structure and specific rules. A liquidity void is a broader concept. It describes an area where price moved so aggressively that very little trading took place. In other words, a fair value gap can exist inside a liquidity void. But a liquidity void is not limited to a single gap between candles. Understanding this difference is important because it helps you focus on the market's behavior, not just the shape of a pattern. Common mistakes traders make. Once traders learn about liquidity voids, they often make the same mistakes. The first mistake is treating every liquidity void as an entry signal. A fast move doesn't automatically mean you should buy or sell. It simply tells you that something important happened. The second mistake is expecting price to react the same way every time it returns. Markets don't follow fixed rules. The reaction always depends on the current order flow and market context. Another common mistake is analyzing a liquidity void in isolation. no concept should be used alone. Always combine it with market structure, liquidity, and confirmation.
How to use liquidity voids correctly.
So, how should you actually use a liquidity void? The answer is simple. Use it as context, not as a trigger. When you identify a liquidity void, don't rush into a trade. Instead, recognize that the market has revealed something important. It has shown where strong participation entered and where price moved with urgency. Then, wait. Let the market give you more information. Pay attention to the overall market structure. Watch how price behaves as it approaches or revisits the liquidity void. Let's quickly recap. A liquidity void is created when price moves so aggressively that very little trading takes place. It reflects a temporary imbalance between buyers and sellers. But remember, a liquidity void is not a trading signal. It's a piece of market information. It tells you where the market moved with exceptional strength. If you found this video helpful, make sure to like the video and subscribe for more price action and smart money content. Thanks for watching, and I'll see you in the next one.